There's a $600 trillion secret holding up the global economy. The same secret that almost destroyed it in 2008, and now it's 10 times bigger, and no one knows how to stop what's coming. This isn't science fiction, it's not a conspiracy theory. It's the world of derivatives, a financial web so massive, so complex, and so deeply entangled in every major institution on Earth, that even the people running it don't fully understand how it works. Behind every trade, every loan, every government bond, this hidden system quietly operates, connecting trillions of dollars through invisible threads of risk. It was designed to make markets safer, to protect against uncertainty. But in reality, it's become the most dangerous structure ever built in modern finance. Because when one part fails, the entire web starts to shake. In 2003, long before the world cared, Warren Buffett issued a chilling warning. He called derivatives financial weapons of mass destruction. Most dismissed it as alarmist. After all, Wall Street was booming, credit was easy, risk seemed to vanish. Derivatives were hailed as the innovation of the century, the miracle that would prevent another Great Depression. They weren't wrong about one thing: derivatives really did change the world, just not the way anyone expected. By 2007, the global financial system was drowning in these contracts, layers upon layers of complex baits, insurance, and counterinsurance, each one tied to another. Banks betting on mortgages, hedge funds betting on banks. Insurers betting on hedge funds. It was a circular machine that only worked as long as everyone trusted everyone else. And that's exactly what collapsed in 2008 when Lehman Brothers fell. It wasn't just a bank going under, it was a thread snapping in a $600 trillion web. That one break triggered panic across the entire world. Suddenly, no one knew who owed what, or who was exposed to whom. Every institution was afraid to lend. Every dollar stopped moving. The global system, built on confidence, froze overnight. And here's the part most people never realized. After the crisis, the system wasn't dismantled, it was repaired with tape and promises. Regulators tried to control it, central banks tried to stabilize it, and Wall Street rebuilt it, bigger, faster, and even more complex. Today, the derivative market isn't smaller. It's nearly 10 times the size of the world's entire economy. And once again, it's hidden from public view. No one truly knows the total exposure, the real leverage, or how deeply connected these contracts have become. It's a financial time bomb, disguised as stability, because as history has shown, when everyone believes the system is safe, that's when it's most fragile. So, how did we end up here again? How did a tool built to protect against risk become the very thing that could destroy everything? And what are the signs that the next detonation may already be ticking beneath the surface? To find out, we have to go back to the beginning, to the birth of derivatives, the rise of financial engineering, and the moment the world unknowingly lit the fuse on a $600 trillion time bomb. To understand how this monstrous system came to exist and why it is spiraling out of control, we have to rewind to the 1970s. Back then, global finance was changing forever. Currencies were no longer tied to gold, interest rates were volatile, and the world entered an era of uncertainty. For banks and corporations, that was terrifying. A single swing in currency values or interest rates could wipe out profits overnight. So, financial engineers came up with a clever idea. What if they could transfer that risk? What if they could make a contract that said, if interest rates go up, you pay me. If they go down, I pay you. That idea, a simple, elegant, and seemingly harmless, was the birth of the modern derivative. At first, derivatives were like seatbelts. They made finance feel safer. A farmer could hedge against falling crop prices. An airline could hedge against rising fuel costs. A bank could hedge against interest rate swings. These early instruments were traded openly on exchanges, with clear rules and transparent pricing. But as the system grew, Wall Street saw something far more lucrative: profit in complexity. By the 1980s and 1990s, the financial world began to drift away from simple, transparent contracts. Instead, they created a darker version: over-the-counter derivatives. Private, unregulated deals made directly between institutions, hidden from regulators, investors, and sometimes even other banks. It was the beginning of the shadow financial system. In the halls of power, these innovations were celebrated. Alan Greenspan, then chairman of the Federal Reserve, praised them as tools of efficiency. Economists argued that derivatives spread risk across the system, making it more stable. But in reality, that spread didn't eliminate risk, it disguised it. Because while every institution thought it was protected, no one realized they were all holding pieces of the same explosive device. Banks started creating exotic products with names few could even pronounce: CDOs, CDSs, synthetic swaps, and more. Each one promised higher returns with managed risk. In truth, they were simply stacking leverage upon leverage. Let's pause here. Imagine a Jenga tower. Each block is a derivative contract, a promise between two parties. Now imagine that tower growing taller and taller, each new deal resting on the one beneath it. As long as no one touches it, it stands, but pull out one wrong piece, and the entire structure collapses. That's exactly what happened in 2008. By the mid-2000s, American housing was considered the safest investment in the world. So Wall Street built an empire on top of it. Banks bundled home loans into complex securities. Then, they sold credit default swaps, insurance contracts, to guarantee those loans would never fail. The logic was, even if some mortgages go bad, the rest will hold. But they were wrong, because these derivatives were all interconnected, and when subprime borrowers began to default, the entire chain of Bates started unraveling. Lehman Brothers, AIG, Bear Stearns, all were deeply tied to these contracts. Each one owed billions to others. The collapse of one meant the collapse of all. When Lehman fell, it didn't just trigger panic. It froze the arteries of the global economy. Money stopped flowing, banks stopped lending. The world's financial machine, worth trillions, seized up like an engine running without oil. Governments and central banks rushed in to stop the bleeding. Trillions of dollars were printed, rates were cut to zero. The biggest bailout in human history unfolded overnight, and it worked, temporarily. The system survived, but the disease was never cured. Because instead of reducing the size of the derivatives market, Wall Street found ways to make it even bigger and far more complex. Here's how they pulled it off. After 2008, regulators like the Dodd-Frank Act in the US tried to impose transparency. They demanded that derivatives be traded through central clearinghouses, institutions that would track and balance these contracts. On paper, it sounded safe, but in practice, it simply moved the risk from thousands of smaller players to a few massive ones. Now, instead of hundreds of banks being tangled together, a handful of clearinghouses, like LCH, CME, and ICE sit at the center of the web. That means, if one of these fails, the entire system could collapse in a single instant. And here's the real nightmare. While the notional value of derivatives now exceeds $600 trillion, the collaterally, the actual money backing those baits, is only a tiny fraction of that. That's like insuring a skyscraper for $10 billion with just $10 million in the bank. It works until the fire starts. Meanwhile, governments and central banks became addicted to this system. Because derivatives don't just amplify risk, they create the illusion of control. Want to keep rates low? Use swaps. Want to hedge currency exposure? Use forwards. Want to stabilize your bond market? Use futures. Every modern financial tool, every policy, every investment is now linked, somewhere, to the derivatives machine. The result, a system that's too profitable to regulate and too interconnected to fail. But here's where things take an even darker turn. When central banks began printing money after 2008, they didn't just rescue the markets, they supercharged them. Low interest rates made borrowing cheap, which meant banks could use more leverage, creating even more derivatives on top of that. The same medicine that saved the patient is now the poison keeping it alive. Today, the global financial system stands taller, riskier, and more fragile than ever. A $600 trillion house of cards built on assumptions, algorithms, and trust. And once again, cracks are starting to show. Interest rates are rising. Debt levels are exploding. Liquidity is tightening. The same warning signs that flashed before 2008 are flashing again. But this time, the system is too big for any single government, or even the entire world, to bail out. So, if this time bomb is so dangerous, why hasn't it gone off yet? What's holding it together? And where exactly are the weak spots that could trigger the next collapse? To answer that, we need to dive deeper into the engine room of global finance, where invisible contracts decide the fate of nations, and where the next Lehman moment may already be quietly ticking away. Deep beneath the surface of the global economy lies a hidden engine, a vast network of contracts, codes, and promises that power nearly every financial transaction on Earth. It's invisible to the public, yet it touches everything: your mortgage, your savings, your job, your government's debt. This is the derivatives machine, and it doesn't sleep. Every second, somewhere in the world, trillions of dollars in swaps, options, and futures are being traded, renewed, or rolled over. And while most of those contracts cancel each other out on paper, the problem is what happens when the paper burns. Because in reality, every bet needs a winner and a loser. And when both sides are highly leveraged, one default can ignite a chain reaction. In theory, the system has safeguards, clearinghouses, margin calls, capital buffers, but theory doesn't stop panic. If confidence collapses, it doesn't matter how strong the rules are, the money simply stops moving. That's the nightmare scenario haunting central banks today. Let's break down how it could happen. Imagine a major bank, say Deutsche Bank or JP Morgan, holding trillions in derivative exposure. Most of those bets are balanced. They owe money to some, they're owed money by others. It works as long as everyone pays on time. But what if one big player suddenly can't? Maybe an unexpected interest rate shock hits, maybe a sovereign bond defaults. Or maybe, like in 2008, the market simply loses faith. Within hours, hundreds of counterparties would demand collateral, liquidity would evaporate. Banks would rush to sell assets, stocks, bonds, anything, to cover their losses. That's when prices start to crash, the collapse feeds itself. Falling prices create more margin calls trigger more selling. And suddenly, the global economy is in a free fall. Again, this isn't just theoretical. We've already seen smaller versions of this chain reaction, enough to prove how fragile the system really is. Take March 2020, when the pandemic panic hit. In just days, the supposedly safest markets in the world, US Treasury bonds, nearly broke. Investors everywhere tried to sell at once. But there weren't enough buyers, liquidity vanished. Even governments struggled to find demand for their own debt. The Federal Reserve had to step in and inject trillions to stop a total collapse. But behind the scenes, it wasn't just fear causing chaos, it was derivatives. Because as bond prices moved violently, the trillions in interest rate swaps tied to them began to unwind. Every move forced financial institutions to post more collateral, cash they didn't have. Without central banks flooding the markets with liquidity, the entire global system could have frozen again. Then came 2022, when a far quieter but equally dangerous crisis unfolded in Britain. The UK pension system, considered one of the safest in the world, almost collapsed overnight. Why? Because of a hidden derivative strategy known as LDI, or liability-driven investment. Pension funds had been using derivatives to hedge their long-term liabilities. But when bond yields spiked after political turmoil, those derivatives backfired. Suddenly, funds were forced to sell billions in assets to cover their derivative losses. That panic selling threatened to crash the entire UK bond market. It was only stopped when the Bank of England intervened, literally buying bonds to keep the system from imploding. One misstep, one market shock. That's all it took to expose how fragile everything really is. And yet, even after those near misses, the world's dependence on derivatives only grew. Today, banks, hedge funds, corporations, and even governments rely on them daily, not just to hedge risk, but to make profits. They become the bloodstream of modern finance, and that's exactly what makes them so dangerous. Because if that bloodstream clots, even for a few days, the patient dies. So where could the next clot come from? Let's look at three of the biggest pressure points quietly building beneath the surface. 1. Interest rate derivatives. After years of near-zero rates, global central banks have raised rates at the fastest pace in history. Trillions in contracts that assumed low or stable rates are now under stress. Banks, hedge funds, and companies that bet wrong on rates could suddenly find themselves insolvent. Even a small miscalculation can trigger billions in margin calls, and those ripple effects can cross continents overnight. 2. Foreign exchange swaps. Every day, around $4 trillion in FX swaps are used by global banks to manage currencies. These deals depend on constant trust, a promise to deliver dollars, euros, yen. But here's the catch: most of these transactions happen off the books. They don't appear on balance sheets, which means no one knows the true exposure. In late 2022, the Bank for International Settlements, BIS, revealed that as much as $80 trillion in hidden dollar debt was buried in these swaps. That's bigger than the entire global bond market, and it's invisible. If global liquidity tightens or if dollar shortages return, these hidden debts could trigger another massive squeeze. 3. Clearinghouse risk. Remember how regulators moved derivatives into clearinghouses after 2008? That was supposed to make things safer, but now, each clearinghouse holds tens of trillions in contracts. They become the new too big to fail institutions, except they're even more concentrated. If just one clearinghouse, like LCH in London or CME in Chicago, suffers a major loss, it could bring down dozens of banks simultaneously. That's the modern version of Lehman, multiplied by 10. All of these risks share one fatal flaw: trust. The entire system depends on the belief that everyone will honor their contracts, that collateral will always be available, and that central banks will always step in when things go wrong. But what happens when that belief breaks? When inflation ties the hands of central banks, when governments are too indebted to print more money, when the next crisis comes not from one country, but from everywhere at once? Then the safety net disappears, and that's the dark truth no one in finance wants to talk about. The derivative market isn't just a tool. It's a gamble on global stability itself. It's a world where trillions of dollars can vanish in seconds, where hedging has become speculating, and where every safeguard depends on the same thing that destroyed us in 2008: a blind confidence. The last time this system imploded, it took down Lehman Brothers, wiped out 20 million jobs, and forced the largest money-printing experiment in human history. This time, the stakes are higher. The debts are larger. The system is far more interconnected. And the same fuse that burned in 2008 is burning again. But here's the question that defines our future: can we defuse it in time? Can the world's central banks, regulators, and institutions truly control something that's grown far beyond their reach? Or is the next financial earthquake already set in motion, waiting for the smallest tremor to set it off? To find the answer, we need to uncover how governments, corporations, and even ordinary investors are unknowingly feeding this machine, and why every fix since 2008 has only made the explosion more inevitable. Here's the uncomfortable truth: the same people who were supposed to fix the system after 2008 are the ones quietly rebuilding it, even bigger, even riskier. They didn't dismantle the time bomb, they just changed its timer. After the last crash, regulators swore never again. They forced banks to hold more capital, pushed risky derivatives into clearinghouses, and demanded transparency. On paper, it looked like progress. In reality, it was illusion. Because while one hand was tightening rules, the other was opening new loopholes. Banks simply moved the risk off their balance sheets into the shadow banking system. Today, hedge funds, private equity firms, and non-bank financial institutions control tens of trillions in hidden leverage. They use complex derivative strategies to amplify returns without being subject to the same regulations as banks. It's like removing the smoke detectors, then filling the house with gas, and calling it safer. And here's where it gets even darker. Governments themselves have become addicted to this system. Why? Because derivatives make debt look smaller. They allow governments to hedge interest costs, delay recognizing losses, and even manipulate how their deficits appear. It's accounting magic until the spell breaks. Take Europe. Before Greece's debt crisis exploded in 2010, Goldman Sachs used complex currency swaps to hide billions in Greek debt from EU regulators. For years, it worked. Until it didn't. When investors discovered the truth, Greek bonds collapsed, and the entire Eurozone nearly followed. But instead of banning those tricks outright, governments around the world kept using them quietly. Even today, many sovereigns still rely on swaps and derivatives to smooth out their budgets and disguise true liabilities. The result? A global web of promises so tangled, not even the institutions managing it fully understand where the real risks lie. Meanwhile, central banks, the supposed guardians of stability, have become the ultimate enablers. When markets panic, they print. When debt piles up, they buy it. When bubbles form, they deny it. It's a loop that feeds itself, and every time central banks step in to save the system, they make it more fragile. Because investors learn one simple lesson: risk doesn't matter. The Fed will always bail us out. That belief created the era of infinite leverage. Zero interest rates made borrowing free. Trillions of dollars flowed into speculative baits, from housing to crypto to derivatives. Wall Street didn't just return to 2008 behavior, it doubled down on it. By 2024, global debt hit $315 trillion, and the derivative market ballooned past $600 trillion in notional value. That's nearly 7 times the size of the entire world economy. And every dollar in that system is connected, directly or indirectly, to government debt, interest rates, or central bank policies. So if one piece breaks, the rest follows. Now imagine this: interest rates stay high to fight inflation. Governments keep borrowing to fund deficits. And trillions in derivative contracts, all based on low-rate assumptions, start unraveling. That's not imagination. That's the current reality. Even the Bank for International Settlements, often called the central bank of central banks, has quietly warned that global financial plumbing is under severe strain. Their words, not mine, but here's the part almost nobody sees coming. While the world focuses on inflation, wars, and elections, the real trigger could come from something far more mundane: a sudden liquidity crunch, a missed payment, a single clearinghouse error. That's all it takes, because the derivative market isn't built for resilience. It's built for speed, and once it starts moving in the wrong direction, no one can stop it. To understand how fragile this web really is, look at what happened in the UK bond market in 2022. British pension funds were using derivatives called LDI swaps to boost returns. When interest rates spiked unexpectedly, those swaps backfired, triggering margin calls worth billions. In just 48 hours, the entire UK pension system was on the brink of collapse. The Bank of England had to step in and print billions to stop the implosion. A small move in bond yields nearly toppled an entire nation's retirement system. That's the power of derivatives. Every crisis in history follows the same pattern: complacency, leverage, trigger, collapse. In 1929, it was margin debt on stocks. In 2008, it was subprime mortgages wrapped in derivatives. In 2026, it could be derivatives built on government debt itself. That's the nightmare scenario no one wants to imagine, because when sovereign bonds crack, there's no bailout big enough. And yet, governments keep adding fuel to the fire. They're issuing record debt to fund wars, subsidies, and social programs. Central banks are trapped, unable to cut rates without reigniting inflation, and unable to raise them without detonating debt markets. It's a slow-motion trap, a mathematical inevitability. At some point, the cost of money becomes unbearable, and the weakest link snaps. Maybe it's a clearinghouse, maybe it's a major bank, maybe it's a government itself. Whatever it is, it will happen fast. Faster than 2008, faster than anyone can react. When that day comes, you'll see markets plunge, liquidity vanish, and confidence disappear. Not because of greed or panic, but because the system was built on fragile trust. And once trust breaks, no central bank, no regulation, no bailout can glue it back together. 3 takeaways before the storm. 1. Complexity doesn't mean safety, it means opacity. The $600 trillion derivatives market isn't a safety net. It's a spiderweb, and everyone is caught in it. 2. The next crisis won't start where everyone's looking. It won't begin with stocks or housing. It'll start deep inside the derivative plumbing, where leverage hides in plain sight. 3. The illusion of control is the greatest risk of all. Governments believe they can print, regulate, or model their way out of danger. But no model can predict a loss of confidence. When people stop believing in the system ends. So when you hear experts say, "Don't worry, the system is stable," remember this: that's exactly what they said in 2007, right before everything fell apart. The difference now, the numbers are 10 times bigger. And the safety nets are 10 times thinner. This isn't financial advice, it's a wake-up call, because the next crash won't just be about money. It'll be about trust, control, and who owns the future of finance. And when the dust settles, those who understood what was coming will be the ones shaping what comes next. If you learned something new today, make sure to subscribe because the story isn't over, it's just beginning. The $600 trillion time bomb is still ticking, and the next sound you hear might be the first crack.